Palacios, Director of Investments at the Center for Financial Planning, and I'd like to talk to you a little bit about inflation, as that has been grabbing some headlines lately. For developed economies, some inflation can be very healthy. When consumers expect prices to rise, they'll go out and purchase goods and services now rather than waiting until later. So while it's likely we think inflation is going to continue to trend higher here in the US, at least in the coming months, the question is, how can this impact my investments, and even how long will this upward trend last? So I like to break inflation down into two different sets of factors. One set of macroeconomic factors, and then also a set of industry factors. So first, let's talk about the macroeconomic factors. Number one, there's a large amount of monetary and fiscal stimulus floating out there. The consumer has a lot of extra money in their pockets and they want to spend this. So this leads to upward pressure on inflation. Secondly, we're starting from a very low base of comparison. So we're comparing today to a year ago when many sectors of the economy came to a grinding halt and weren't yet reopening. So when you compare something to nothing, it can look much larger than it actually is. So a year from now, we'll have a much more normal base of comparison. So that is one of the reasons why we think that inflation may not be lasting, at least at the levels we've seen lately. Wage inflation. So this is a big factor for inflation, and it's been essentially non-existent for many years now. Wages rising, they're rising trying to entice people to come back to work. Once government transfer payments run out or slow down, many of these individuals will likely return to the workforce again, causing that pressure on wages to return back to more normal levels. And lastly, there's really still a complete lack of velocity of money. Quite simply, banks aren't loaning the money out that they're flush with. So next, let's turn to some industry-specific impacts on inflation. On the top of everyone's mind lately has been supply chain disruptions. There's been a lack of manpower, import choke points. Companies simply can't make enough of different products to meet the current demand because the consumer has a lot of cash to spend right now. This will likely work itself out throughout the remainder of the year as consumers spend down their balances and the import choke points kind of open back up. We should see that start to relax. Technology is really increasing productivity. In the past year, we've had a dramatic shift in how people work and taken a fundamental leap forward in technology. And quite often with these leaps forward, you see increases in productivity, which over time puts downward pressure on prices. Through careful financial planning, we can plan for inflation at a higher rate than it's been in the past. The investment committee also spends time discussing the possibility of higher inflation and what that can do to your investments. So the good news is, when you're starting from a low base of inflation, some inflation can be good for many different styles of investing. Feel free to check out the written portion of this blog for more information. Please comment below if you have any questions on this topic or if you'd like to hear more about it. In our second quarter investment commentary, we'll dive a little deeper into any questions that you may have. Thank you for listening in.